Okay, welcome. This is going to be an e-tutorial on how to solve problem E14-2 from your workbook. So Nest Corp reports the following transactions for 2020. We're given a list of transactions here, and what's required at the end is to prepare the journal entries for the above transaction. Explanations are not required. So we'll go through this one by one, starting first with January 27th. So it tells us that we sold, or Nest Corp, sold 30,000 shares for $10 per share. Why would they do that? One, well, maybe they needed financing, they needed to raise cash, and they decided to do that through an equity issue by raising common shares, or by issuing common shares. So if they issued 30,000 shares at a share price of $10 per share, what they raised in the amount of cash is going to be $300,000. So before we do the journal entries for this, I'm going to give myself a little cheat sheet. Remember from class, DC Adler. So DC Adler. Debit, credit, asset, draw, expense, liability, equity, revenue. I'm just going to make this a little bit prettier for us. Okay, so we know this company raised cash by issuing shares, so we know cash is going to get increased. Cash is an asset account, so to increase assets, we debit the asset account. So I'm going to put cash here as a debit by $300,000. I got that because we issued 30,000 shares at a share price of $10 per share. So since we issued common shares are an equity account. To increase equity, I credit equity. So common shares, $300,000. And now we're done with January 27th. So this is done for us. I'm going to make this a little bit prettier by getting rid of all of my markup so we can proceed cleanly with the remaining transactions. Okay. On February 1st, there was another equity issue. This time, the equity issue was with preferred shares. So remembering from last week, preferred shares have a liquidity preference over common shares. So they're paid a dividend first, and in the event of bankruptcy or wind down, preferred shareholders have a higher claim to the residual assets over common shareholders. We don't need to know that in order to do the issuance of preferred shares right now, but it is good to know that moving forward. What we need to know right now are how many shares were issued, 6,000, in the issue price, $70. So $70 multiplied by 6,000 shares is going to equal, hopefully my math here is right, 420,000. So that's how much cash was raised. We know cash is an asset. And to increase assets, we debit an asset account. So that's going to become debit here, cash, 420. And let me just double check that by doing the actual math here. $70 multiplied by 6,000, 420,000. It matches. So that's good. This time we didn't issue common shares, we issued preferred shares. So that's going to be our credit, preferred shares, 420,000. Crediting it because, well, preferred shares are a type of equity. So to increase equity, I credit equity. And now we're done with this February 1st transaction. I'm going to get rid of all this ugly markup. Okay, So before I move on, I do want to talk about a couple of items related to the February 1st transaction. You probably noticed this $1.50, and why did I not use that? Well, remembering from class, preferred shares have what's referred to as a fixed dividend rate. The $1.50 here refers to the dividend rate, not the actual share price. So we don't need to know that right now in order to solve this problem, but it is good information to know. Additionally, there's this terminology here right next to the $1.50. It's called non-cumulative. What that means is if we don't pay dividends this year, they don't carry forward in arrears to preferred shareholders for next year. When they do carry forward as dividend in arrears is if the preferred shares are known as cumulative. So just a refresher on some of the terminology we discussed in chapter 13. And now moving forward, it's October 13th, and we declared a 10%, or Nest Corp declared a 10% stock dividend on common shares. The current market price of common shares is $12 per share, and there are 90,000 common shares outstanding on October 13th. So dividends don't always need to be paid in cash. Sometimes they're paid in additional shares of the corporation. So why would they do that? Well, there's a couple of reasons why. One, maybe they don't have the cash, but they want to maintain a dividend payment, so they instead issue more shares in the company. That's a reason why they could do it. So if they declared a 10% stock dividend, the current price of the stock is $12, and there are 90,000 common shares outstanding. I'm going to use those numbers in order to calculate the amount of additional stock that was issued. So 12 multiplied, that's $12 per share, multiplied by 10%, that's the stock dividend rate, as well as 90,000 common shares outstanding. So if I multiply all of that together, and I'm not going to try and do that in my head, I get $108,000. So I did this here, there. Now, just like shares, or sorry, just like dividends that are paid in cash, dividends officially come out of retained earnings. Remember, retained earnings is the cumulative amount of net income that a corporation has earned over time, accumulates in what's called retained earnings, and dividends are then paid out of retained earnings. Since dividends are paid out of retained earnings, and retained earnings is an equity account, to increase equity, I credit equity, but I'm not actually increasing equity here, I want to decrease it. So I do the opposite of what's highlighted in this chart. So I'm going to debit my retained earnings account because I'm lowering retained earnings. And instead, what I'm going to do here as a credit is put common stock dividend distributable. Why? Well, because this is the declaration date. If I look at how the terminology is, it says it's declared. It doesn't say we've actually issued them, we've declared it. Therefore, we have to distribute stocks at a date in the future. And now we're done with October 13th. Let me clear all of this markup. Okay, now we're ready to proceed with November 16th. On November 16th, the terminology, note the terminology. Now it said they distributed the stock dividend that was declared on October 13th. So we set up a common stock dividend distributable in the amount of $108,000 on October 13th. We now need to reduce that to 0 because we're actually issuing the shares now, the stock dividend. So this is November 16th, stock dividend distributable. That is 108,000. Excuse me. And what we're actually doing is we're increasing common shares by 108,000. Now we've issued the shares as a stock dividend to the owners of the corporation, the shareholders. We're done with November 16th. There's only one date left. We're doing good. It's December 11th. Now notice here it says it starts with the word declared, an annual dividend. So here I'm going to say, since it gives us an amount in dollars, expressed in dollars, this is 35 cents. This is going to be a dividend payable. This is going to be paid in cash in the future. It's not going to be paid as an issuing stock dividend. So we've declared an annual dividend required on the preferred shares. Remember, preferred shares have what's referred to as a fixed dividend rate. And if we look at the February 1st line item, the fixed dividend of the preferred shares is $1.50. And then a 35 cents per share dividend on the common shares. So we're paying dividends on both the preferred shares and the common shares. But remember, preferred shareholders have the liquidity preference. So if there isn't enough to pay the common shareholders, we have to pay the preferred shareholders first. And then it tells us there are 20,000 preferred shares outstanding at this time. So since this item here is just declared, and we're going to be paying a cash payment in the future, we're going to have to set up a liability for it. So we're going to have a dividend payable for both the common shares and the preferred shares. To increase a liability, I know we credit a liability. And I also know that dividends are paid out of retained earnings. Retained earnings is an equity account. To increase equity, I would credit equity, but I don't want to increase it. I want to decrease it, so I do the opposite. So I'm just going to get my journal entry structured here. Retained earnings is going to be my debit. I'm going to have a dividend payable for the common shares. Or I should write the preferred shares first because they have the liquidity preference. Okay. So my journal entry is structured. All I need to do is populate the amounts. I'll calculate the preferred shares first. It tells us there are 20,000 preferred shares outstanding at this time. So 20,000 multiplied by the dividend rate given on February 1st, $1.50, $1.50 per share, remember. It's going to be $30,000. That's what we owe in dividends as a cash payment to the preferred shareholders. So just to recap, $1.50, that's the fixed dividend rate, and that's given on the February 1st line item, multiplied by 20,000 preferred shares outstanding. That was given to us in the December 11th line item. Just clean this up. Bear with me for a minute. Okay. Now, we're almost done. We have to figure out what the dividend payable on the common shares is going to be. We know there's 35 cents per share. We just need to know how many shares are actually outstanding. If I look through this problem on October 13th, there was 90,000 common shares outstanding. That was on October 13th. But then on November 16th, what Nest Corp did is they distributed the stock dividend declared on October 13th. Remember, they issued 10% additional shares through a stock dividend on October 13th. So what we need to do is add 90,000 times 10%, which is going to be 9,000 shares. So we had the original 90, and then on November 16th, there was 9,000 additional shares issued for a total of 99,000 shares. That's common shares. So the dividend rate we know is 35 cents, and there's 99,000 shares outstanding. I'm not going to try that math in my head. I'm going to do it in Excel. So 35 cents multiplied by 99,000 is a dividend payable of $34,650 to the common shareholders. So let me make this a little bit cleaner before I go on. Bear with me, I know this takes time, so sorry about that. The benefit of doing these video lectures is that you can actually watch them at 1.25 speed or 1.5 speed and fast forward basically through all of this. Okay, so that means retained earnings is going to be decreased by the 30,000 we need to pay to the preferred shareholders, plus the 34,650 that we need to pay to the common shareholders, so $64,650. That's it. We're done with December 11th, and we're completely done now with all of the requirement from this transaction or from this problem. So thank you for listening. If you have any questions, feel free to reach out to me or to any of your instructors, and they'd be happy to help you. Otherwise, my name is Kyle. Have a great day.